Now, let's talk a little bit about stock charting, where we are in the market right now, where things stand, and what to look for when deciding, hey, I want to get into the market, I want to get into a new position, I want to make some money, which is what we all want to do. Well, the first thing that we always have to discuss in situations like this is where are we now? Let's take a look at the current stock chart of SPY, the S&P 500 ETF. This is the 1/10th mirror of SPX, the index, broad-based index for S&P 500 stocks, the Standard & Poor's recommended 500 stocks. Over the past 3 weeks or so, we've seen a decline from the peak of 565 down to 510. 55-point drop, so we're looking at an 8 to 9% what we'd call correction. Now, a lot of this was due to the recent news that came out in the last 3 days. Some poor earnings, some poor economic reports. It started on Wednesday with Powell from the Fed saying they weren't going to cut the interest rates in July, they're going to wait. And now they're talking, of course, that we've seen the jobs report, the problem with the yen over the weekend, which caused Monday's rout globally and further declines, as well as poor earnings from some of the bigger stocks that we've seen, the Magnificent Seven and others. That's where we are right now. Everything is not doom and gloom, but everything is, in fact, bearish. Now, with just the fall in the last few days, why am I saying that we've seen a negative trend in the past 3 to 4 weeks, starting roughly around July 16th? And that's because we are riding high. What you're looking at here on the top chart is what's called the upper and lower Bollinger Bands. This is a 20-day moving average on a trend against a security. When stocks are riding the upper band, or if you see a Bollinger Band break out to the top, where it rises above the upper band and closes above the upper band the next day, that's a positive bullish signal. We can see that here back around June 17th. We can almost see it here, but not quite, but we're still in a good uptrend. The yellow line is simply the 20-day moving average, the simple moving average of the security. We want to buy securities when they're trading above the SMA 20 and potentially riding this upper Bollinger Band, especially in these situations where we see a Bollinger Band breakout, as we did here at roughly about 540, 542, and saw it again over here at around 550. That rode us up to 565. Down here, this red and blue line is known as the MACD. The blue line is a combination of the 12-day and 26-day moving convergence averages. The red line is the 9-day exponential moving average. It's considered a slow line, whereas the 1226 is considered a fast line, reflecting the movement of the stock in the last 12-26 days. Divergence. Now, this just does these black histograms. It's just measuring the distance between the two. When you see the divergence below the quote-unquote zero line, that means the positive 1226 MACD, the fast-moving line, has crossed below the EMA 9. Usually mirrors a bearish trend. When you see the blue line, 1226 MACD, cross above the 9-day exponential moving average, that's usually a bullish sign. As we see here, the stock, the ETF, SPY, just moved above the 20-day moving average, and we see a positive MACD crossover. We start to see separated divergence, but here on June 5th, when the market SPY, SPX index broke above 530, that would have been a good buy point, and we see that trend continue. With some inflections, mirroring around, but we're staying above the 20-day moving average. On the 12th, we're riding pretty high, July 12th. And July 16th, we're still riding pretty high. Then we see a breakdown. SPY drops below the SMA 20, and we see that negative MACD crossover. And it's still going down. This is relevant because we're not seeing a bottom. What we want to see is a bottom trough on the blue line. Here, inflection point around July 1st as well, where it looks like weakness is coming in, but it bottoms and then crosses back over. We're nowhere near a bottom right now. Some of the recent positions I've been in married put portfolios, protected positions, Trex is one of them. Originally got into the stock a few months ago at a cost of about $82, $83. The stock moved up. We were able to make some adjustments. We own a put option as well as the stock. It's like insurance for the stock. So the most I can lose, even if the stock fell 20 or 30%, is 5% on the position. We'll talk more about strategy terms later. But as you can see, it's been sort of a roller coaster ride. Back on July 10th or 11th, what did we see? Here is a perfect bottom of the MACD. The stock had been declining well below the SMA 20. I'm looking for a point to make an adjustment on this trade to adjust that insurance policy while staying in the stock. And we see this bottom here that I want to see. And then it starts to click back on the 10th above the EMA 9. We have a positive MACD signal, and the stock is bouncing off the bottom Bollinger Band, the lower gray line again, and moving up to the SMA 20. This would be a perfect buy point on this position. All signals reflecting bullish. Although I'd like to be above the SMA 20 when I do this, sometimes in this situation, so I was always protected, I'm not looking for an entry. I'm looking for management to cut the risk down, average the cost down on this existing position, and that's what we did. We adjusted the option to get a lower cost basis on the stock with a new put combination, able to ride the stock back up here, where we're at a loss of about 5 or 6% here. Because we lowered the cost basis with the technical trend we were looking for with the MACD, we were able to get a profit at this point. Now, it's fallen again, a negative crossover. And tomorrow, it's going to open at about 66 because of poor earnings. Thankfully, we've already gotten out of this position. But here you see what I'm looking for. Bottoming of the MACD to get back in and a positive crossover approaching or even above the SMA 20 before I'm confident that we should go back into bullish positions. Let's go back to the S&P 500. What we're seeing here is yet still declining MACD, going below the divergence line, and that divergence is increasing, not decreasing. They're not getting closer together. Let's look at QQQ. This is the ETF of the NASDAQ 100, the tech stocks, the Magnificent Seven, NVIDIA, the AI stocks, Apple, Meta, everything like that. Same thing. Look at that crossover on or around July 12th on the MACD. Stock drops below the SMA 20 right around the 17th. And since then, with those bearish signals, it's moved straight down. It was at 500, but when we saw the signals is at 485, dipped down to 425. NASDAQ moves faster than the S&P 500. Tech is more volatile. So in this case, that loss, let's just call it 485 to 425, 60 points on a 485 stock or security, you're talking about a 13 to 14% decline in a 3-week period. Most corrections, market-wide, are between 7 and 10%. This one has been amplified due to the changes of the economic factors that are reversed of what the market was betting on. The market was betting on a rate cut in July of 0.25 or 0.5% on the interest rates. They didn't get that. That was back here in the middle, 24th, 25th, and 26th. That's why you had that drop there. Then the problem globally with the yen, they cut their interest rates and the yen sort of tumbled or had some kind of issue. You had that big drop on Monday across global markets, and you say, oh, but it's moving back up right now. But is it? One thing I mentioned to you in the message was a dead cat bounce. What is a dead cat bounce? Well, let me take a look at one other security here, Pure Storage. Another one I'm in is a Marriott put. During webinars for Power Options clients, I was looking for opportunities for a crossover. Now, luckily on this position, we got in back here at about 56, 57. No, yeah, it was about $56 or $57 per share. We were able to ride it up here to potentially have no risk on the trade, a guaranteed profit of 2%. This again is that combination of stock plus put that's far out in time. We'll explain that later. Now we see a negative crossover here on around June 20th. And of course, it's dropping below the 20-day moving average. That would kind of indicate a sell signal, but what happened? Well, it starts to move back up, then it has a big drop again. So that right there is what you consider a dead cat bounce. We had a severe decline, tried to fight back a little bit, and then boom, down again. We try to fight back a little bit. We go above the SMA 20, but what are we missing? We don't get the positive MACD cross. The blue line does not cross the red line. Fast line does not cross the slow line. It's not a pronounced bullish trend, and the divergence is still all negative. The histogram is all on the lower end of the zero line. Once again, big drop, some averaging down, some buying, still decline because the stock is weak, some averaging down, some buying, and then we drop from 65 down to 50. 15 points on a $65 stock. That's huge percentage-wise, okay? We didn't get the crossover we wanted. I was looking to see the crossover here to manage the position, and it didn't happen. It continued to move down. This is still in a strong bearish trend, but you see what here, in this period from July 26th to about June 12th, June 26th to July 12th, strike that, reverse that, you're seeing a dead cat bounce. It tried to fight back and couldn't, and then it just declines. This movement here today on SPY and on QQQ still looks to be the start of a dead cat bounce, where it's going to fight to try to move back up. Most of us think there's still more downside coming due to those fears I mentioned. All of that can change at the drop of a hat based on what the Fed decides to do with any emergency rate cut coming up. They do that in the middle of the week. They do that in the middle of this week, the middle of next week. They cut it to 0.25 or to 0.5 because they said, hey, we were wrong. We needed to do this. We didn't. Now that we've got the labor numbers, the unemployment rates, we were wrong. We have to do this emergency cut right now. The market's probably going to react to that favorably. But it's an outside influence. What we're talking about are trends historically that have worked as indicators to tell us directions of the current securities. Now, all that being said, everything I've just said, you said, okay, well, you've told me that there are options trades I can take in a bearish market. There's options trades I can take in a bullish market. There's ways that I can use leverage to profit if the market continues down. Why am I not doing that now? And the reason why is because the VIX, the volatility index across the market, is still extremely high. This went up as high as 46. Actually, I think it went as high as 65 on the big down spike on Monday. On July 12th, this was at 1250, this underlying index. Now, what the VIX measures, it's not like an index that's measuring stock securities. It's measuring the market expectations of where volatility might be in the next 30 to 60 days. As the market changes, it can be used as a counter hedge, meaning that if the market is dropping, VIX is rising. If the market's going up, the VIX is falling. I use this as a market hedge. When the VIX is below 13 or 1250, I usually buy quote-unquote call options on the VIX that are usually 45 to 60 days out in time. In combination, when I see the Power Options Market Sentiment Tool, the company I work for, have multiple bearish sell warnings and extreme bearish sell warnings in a row, 2 or 3 in a row, July 11th and July 12th. So we bought calls on the VIX, 16 strike for August 21st, bought 8 of them at 82 cents, so it cost about $564. And we closed half of them at a $570 profit a few weeks ago when the market fell down to 55.05, and you see that we start to go to neutral. But then the market continues to fall, and at this point, the profit was in the 1,600%. The remaining 3 or 4 calls I had, I sold another 2 or 3 later on for about a 700% profit, and then here sold them at that point when the SPX was at 51.86. But what you're looking at here is we had a light bullish buy warning come up on the market sentiment tool, on Power Options. We see a little movement here from the low of 51.86 to 52.40, and we've gone back to neutral. I want to see multiple bullish buy warnings in a row, not just this one. The last time we saw a bullish buy warning, a light buy warning, as you can see, was back on May 1st. That's what this bottom graph is showing you. The green and the red are the market sentiment. This is based on 13 broad-based market indicators using the histograms historically of those values of those securities, indicators, over time. But as you can see, when you start to see the bullish buy and light bullish buy warnings, this blue line is the SPX, the SP 500 index. So we're getting screaming strong bullish buys here back in November of 2023 when we were down to 4,200. What happened after that? Well, we went up to about 5,200. We have some sell warnings appear in multiple instances. The SPX drops from 52 down to about 5,000. We start to see the bullish warnings. We ride that trend. And then, as you can see, the bearish sell warnings really started to trigger right here on July 12th and July 11th. That's when we go back to those other charts when I was hitting on the days of July 12th. When you saw that MACD, let's go to SPY. July 12th, still strong, but a few days later on the 17th, you see that. These are indicators I use. Everything right now, even though one light bullish buy just appeared, I'm looking for stronger bullish buys or at least two light buys in a row. Alleviating back to neutral tells me this is more of a possibility of just a dead cat bounce. There's some buying pressure here, and it came up slightly. Here's SPY again, the S&P 500 ETF. Here's the NASDAQ ETF. We're not seeing the bottom that I want to see on the MACD. Not seeing the bottom, seeing increased divergence and increased negativity between the red line and the blue line of the MACD versus the 9-day EMA. Still looking bearish. Not the bottom we saw here, and this is what we're looking for. We're looking for this trend, a changing of the histogram from the lower range to the upper range, or at least a decreasing divergence volume and up into this level. We want that crossover. We want to be approaching or above the SMA 20. That's when we're going to look to do it. Now, there are many stocks that have that right now. Cinemark, for example, on strong earnings has bucked the trend of the common market right now. It had that strong bearish bullish crossover, bounced above the SMA 20, and this is mostly earnings related and things of that nature. And it's just been going up, up, up. Now you say, well, I don't necessarily want to get into it if it's going up, up, up. It's hitting new highs. I shouldn't be buying at this time. But everything technically is telling us this is a buy point for this position. Yes, the best buy point was right here on the 30th when we were around 23. Maybe even before the cross if you could count it at 26, but I wouldn't have been confident in this yet because I think the earnings came out in this period later on, and that's what drove the stock a little bit more. Plus some of course, the movies that have been coming out in the summer that have actually done well where the first batch didn't. That's a whole nother analysis we're not going to get into right now when we go into sector and industry. So that's why I've been saying the things that we're saying, that right now might not be a time to buy into the new bullish positions because it still looks like we're in a bearish trend market-wide. I don't think we want to necessarily, let me get out of the market sentiment real quick, go back to the Power Options homepage. And I'm not saying I want to do bearish positions right now either, especially speculative buying puts, because the volatility is so high, all of the puts are inflated. You're paying more for that expectation and what's concerned as market risk, what's considered as market risk. That's what the volatility measures, the fear gauge in the market. Higher fear, more inflated prices on the option premiums, the cost of intrinsic value and what's called extrinsic or time value. Buying put options to continue the bearish play is going to be very expensive. And the concern is the big drop where we could have profited on the put options, where we did profit on the VIX calls, is now run its course. There still might be room for downside, but it's going to be much slower. And it's going to be much more tame. It's not going to be a big return using the options leverage. Or it could be, depending on what new news comes out next. That's something we can't count on. That's something we can't factor into a stock chart, but definitely something that we're looking into and you want to keep in mind. What's going to come up with the different news reports. Not too many big earnings coming up this week. Don't know if the Fed's going to do that panic rate cut, which, again, I said should make the market go up. But if the market loses favorability that the Fed even has a clue what they're doing, because they said just a week ago we're not going to cut the rates and now they're doing an emergency rate cut, you know, there's not a lot of faith going on in what they're doing, honestly, across the market. So that's another concern where the market might actually go more negative, even though the rate hike cut might improve the economy or give ease to the American consumer. We'll just have to see. But that's why we're not doing anything right now. That's why we're waiting. We're waiting to see more bullish buy signals, and we're waiting to see the bottoming of that MACD line and getting closer, of course, to the SMA 20. That's the trend we want to look for. not the dead cat bounce, but more of a pronounced what's called cup and handle position with the proper technicals involved in the charting also. More updates to come, more insight into options trades and other terms that I mentioned. But for now, standing pat on existing positions, not taking speculative bearish positions at this time due to the uncertainty in the market one direction or the other, while at the same time concerned about the outside forces of the Fed that could come in and the increased prices due to increased volatility across the market.